Hello and welcome to this video on selecting sources of finance. Having looked into the sources and methods of finance, both internal and external, it's important we think about which source of finance the business should choose and which is the right one. So finance is needed for a number of different reasons. For example, for the business to set up, to continue with its day-to-day trading, or to grow and expand. So one key question might be how much finance is needed. If you're considering a project that you estimate will cost £10,000, would you look to generate £10,000 worth of finance, or would you need a safety buffer? Would you consider 12,000, or would you consider different amounts from different sources? Secondly, when is the finance actually needed? Do you need your £10,000 all at one time, or is that £10,000 you're going to be spending over, let's say, 4 years, in which case you only need to take or use £2,500 at a time? And so selecting the right source of finance comes with some challenges. Can you keep control of the business, or are you going to have to sell off some of your ownership? What is the best source of finance to help the business survive? Is interest payments the most appropriate, or only paying back investors through a dividend? So several factors might affect the type and amount of finance required. So for example, what is the finance actually needed for? Is it to finance long-term assets like a new factory, in which case a long-term loan might be appropriate, or is it a short-term requirement to maybe increase your stocks in the next couple of months, in which case perhaps trade credit would be more appropriate? Secondly, an important consideration is how much is the finance going to cost. If you take finance from a bank, you're going to have to pay back plus interest. But issuing shares, share capital also has a cost, because the dividends, the returns, that will be required by the shareholders. What is the flexibility of the finance? For example, taking a bank loan will entail regular payments plus interest, whereas issuing share capital, the dividend doesn't have to be paid and it might be a bit more flexible and infrequent. And then lastly, what is the business ownership structure? Limited companies normally find it easier to raise finance than sole traders, so that might narrow down some of the options that are available. So there's a wide variety of potential sources of business finance, and one way to think about it is the short, medium and long-term sources. So long-term source of finance the whole business's activities over many years, might include share capital, retained profits, venture capital and long-term bank loans. These would be sensible options to consider for a long-term investment. More medium-term, so major products or assets with a long life, maybe bank loans or leasing or government grants would be more appropriate source of finance. And finally, short-term source of finance to keep the business solvent and in day-to-day trading. Well, overdrafts, trade credit and short-term loans would probably be more appropriate for finance that is required only for a short term. So this is a very good way of thinking about what the correct source of finance should be. Is it for a long-term purpose, a medium-term purpose or a short-term purpose?